Distribution channels. Establishing routes to market. It's not unusual for startup companies to succeed in assembling a team, building a product that customers want to buy, but stumble when it comes to building a viable route to market. The cost and time involved in building a channel that delivers a pipeline of sales often dwarfs the investment required to build the product itself. Many of the most successful high-tech companies like Microsoft, Intel, Hewlett-Packard and Apple have spent billions of dollars and taken decades to establish their distribution channels, and the cost and time required to build a sales, marketing and distribution operation can present a significant barrier to entry in many business sectors. There's no shortage of entrepreneurs, universities, research labs, and large corporations inventing new products. The products are often highly desirable to a large market of customers, but the channel connecting the products to the market acts as a choke point that restricts many compelling new inventions, technologies, and products from reaching the market. Channel strategy is core to the success of the company, and the choice of routes to market should be considered in conjunction with the company's business model. Please see the slideshow on business models for more information on this important related topic. Although the Internet now provides rapid access to customers, effective distribution channels usually take years to develop. Generally, the larger the market, the more complex the channel, and the more expensive it is to develop. Establishing routes to reach millions of customers is particularly costly. For this reason, for some time now there's been a trend for startup companies to focus on business-to-business opportunities and avoid the channel challenges inherent in business-to-consumer markets. When negotiating distribution agreements, one of the key issues to consider is exclusivity. An exclusive arrangement may allow the distribution partner to invest in the marketing and promotion of the product and may be necessary to gain access to an international market. But a worldwide exclusive arrangement can lock the company into one channel and restrict the possibility of selling the company in future. Channel relationships often lead to bigger things. Many mergers and acquisitions result from relationships that were initiated as distribution arrangements. Sometimes a large corporation sees the products from a small startup as complementary to its product line and enters an agreement to distribute or bundle the startup's offering alongside its own products. Essentially, this is an opportunity for the startup to piggyback on the channels established by the corporate partner. If the marriage of products is successful, the next logical step might be for the corporate partner to acquire the startup. However, if the distribution arrangement provides the corporate distributor with all the rights it needs to bundle the products ad infinitum, there's no need for the acquisition to take place. For more information on negotiating terms that do not harm the company's future chances of being acquired, please see the slideshow on unintentional poison pills. These partnerships do not always have a happy ending. Channel relationships sometimes also lead to disputes over issues such as ownership of intellectual property and breach of contract. One of the distribution channel options available to a startup is to sell directly to customers. This is how certain big-ticket items such as airplanes, mainframe computers, and expensive software systems are often brought to market. The cost of setting up direct sales operations can be high, and compared to leveraging channels owned by third-party distributors, direct sales is not easily scalable, especially in new countries and new market sectors. Expansion involves recruiting sales staff, which increases the cost structure and takes time. Establishing global reach with a sales team can take decades. The advantages, however, include direct control over the sales activities and a direct relationship with the customer. By providing a direct, low-cost connection between the company and the customer, the Internet has had a significant impact on marketing communications and customer relations. Companies like Salesforce.com, software as a service companies, and shareware software developers use the Internet to reach customers directly, sell their products and services, deliver their products and services, and collect payment. The cost of establishing an Internet-based distribution channel can be relatively low, but it does require the company building a robust e-commerce platform. An automated Internet-based sales and marketing channel is usually highly scalable and provides access to customers all over the world. Total dependence on the Internet, however, can be a disadvantage when the network or part of the network goes out of action for some reason. One of the issues to consider is digital signatures and the validity of contracts formed without a handwritten wet ink signature. To resolve any disputes around the validity of contracts formed online, the U.S. Federal Electronic Signatures in Global and National Commerce Act, e-sign, regulation was enacted in the United States. Under the provisions of e-sign, a contract or signature may not be denied legal effect, validity, or enforceability solely because it's in electronic form. This simple statement provides that electronic signatures and records are just as good as their paper equivalents, and therefore subject to the same legal scrutiny of authenticity that applies to paper documents. Since e-sign was enacted in 2000, the Internet has become a significant distribution channel for many types of startup companies. High technology companies marketing complex products that require installation, customization, and support often sell through a network of value-added resellers. This allows the company to focus on technology development, building compelling products, and to outsource the sales and distribution functions to a network of local resellers with specialist capabilities to add value and deliver complete working solutions to the customer. The extended reach and capabilities offered by the resellers enables the company to scale its business relatively easily. The company does not have to incur the cost of hiring its own staff in order to grow, and is able to scale up by entering distribution agreements with additional resellers. However, the cost of engaging with resellers, educating and supporting them can be considerable. Compared with operating a direct sales team, distributing via a reseller network involves losing direct control over the customer experience. Unlike a direct sales force, focused exclusively on representing the company, resellers may sell competing products. This may create conflicts of interest between the company and the reseller. Other issues of concern to weigh against the benefits of the third-party reseller channel are potential disputes over customer ownership. Who owns the relationship with the customer? The company providing the product, or the reseller that sells and installs it? Another issue resulting from the lack of direct customer relationship is technical support. The company is often unable to rely on the reseller to provide technical support and establishes direct support helplines to supplement those provided by the reseller. Companies such as Broadcom and Qualcomm have built very profitable businesses by developing patented technologies they license to product manufacturers, producing cell phones and related wireless consumer electronics devices. Essentially, these companies don't build their own products, but create technologies that are licensed to organizations commercializing new products and solutions. Google Android is another example, as the operating system is licensed to cell phone handset manufacturers worldwide. Sales and marketing costs are minimal, as the company is selling licenses directly to a highly targeted base of licensees. This strategy is also highly scalable. The costs of scaling up to manufacture and supply increasing volumes of product are borne by the licensee, not the licensor. The developer-licensor focuses on inventing the core technology, and the licensee has the burden of building products, selling, marketing, and supporting them. On the other hand, where the product manufacturer may book revenue of, say, $100 for selling the product, the license fee paid to the licensor may be measured in cents or in a few dollars. So in absolute terms, the royalties can be relatively low. Another feature of this business is that it requires an army of lawyers. Without a realistic threat of patent assertion, manufacturers may prefer to infringe the patents rather than pay license fees. An army of lawyers is required to provide the threat of litigation necessary to compel infringers to pay licensing royalties. When entering these license arrangements, the company must be prepared to negotiate issues of exclusivity. Licensees are likely to request exclusive rights to certain territories or fields of use. Franchisors distribute their products and reach the market through a network of privately owned franchisees. Examples would include companies such as Subway, Burger King, 7-Eleven, and Best Western Hotels. The setup costs can be significant, as franchisors have to invest in building and maintaining the networks, as well as demand creation activities such as advertising and marketing to customers. Many companies choose the franchise channel for scalability. The company is able to grow with very little investment in new outlets. Additional retail units are usually financed by the franchisees. A disadvantage is the lack of direct control. Where a company might directly control its own sales staff, the control via a franchisee is indirect, and this can present difficulties in setting consistent standards across all the outlets. An issue for franchisors to consider is regulation. When soliciting franchisees, the franchisor is subject to disclosure regulation in the United States. Often a company expands into new markets by appointing national distributors. The company sells products through distributors who then resell through their own distribution channels. Ingram Micro would be an example of a national distributor in the United States, and Computers Unlimited would be an example of a national distributor in the UK and some other European markets. An advantage of this channel is scalability. It enables the company to enter new markets and grow relatively quickly. Unlike a republishing arrangement, the company usually is able to retain full ownership of its brand and intellectual property. Unless an exclusivity and long-term arrangement is put in place, distribution contracts can usually be readily unravelled. Establishing distribution arrangements can take time, however, and the international travel required can be somewhat costly. A disadvantage, certainly with US distributors, is that they're designed to fulfill demand, not to create it. US distributors are accustomed to fulfilling the demand created by US vendors themselves, and tend to focus on shipping, warehousing, and logistics rather than marketing and promotions. In international markets, where the product manufacturer does not have to operate a local office or conduct local advertising, distributors are accustomed to being required to perform a more comprehensive service that often requires investment in local advertising. In these situations, the distributor is likely to want some form of exclusivity to justify the marketing spend on the product. Publishing is a route to market for authors, software developers, and creators of all forms of intellectual property. Instead of establishing its own customer sales, marketing, and distribution operation, under the publishing model, The company provides the intellectual property to a publisher who productizes the offering and brings it to market. Examples are commonly found in software and content businesses, where publishers such as Sony and Broderbund publish games created by small independent developers. This approach enables the company to leverage the sales, marketing and distribution channels of the publisher and rely on the publisher for marketing. It's highly scalable, as the publisher often has sophisticated channels, providing access to huge markets. The developer incurs R&D costs, but very little in the way of marketing costs. A disadvantage is the relatively low royalties that are earned by the developer and paid by the publisher. These publishing arrangements are also difficult to cancel or unravel if things don't work out. Issues to consider are the ownership of the product. Does the intellectual property belong to the publisher or the developer? A corporate acquirer might be primarily interested in buying the company's product designs or other intellectual property, and a long-term exclusive publishing arrangement can lock the company's crown jewels, making them unavailable to a potential acquirer. This form of distribution arrangement can trap the company into a situation where it's unattractive as a target for acquisition. Under a republishing model, the company sells its products, normally in foreign markets, through exclusive distributors that localize for local language and characteristics. Republishing differs from publishing in that the company may publish and distribute its own products in its home market, but engage with local foreign language publishers who republish in overseas markets. The overseas partner is not the original publisher, so is actually republishing the localized product for this particular audience. As an example, in August 2009, Square Enix was appointed exclusive Japanese language republisher for Ubisoft games. Ubisoft publishes Prince of Persia and other games for itself in French and English language markets, but now relies on Square Enix to translate into Japanese, localize, and market the games in Japan. As the cost of localization is usually borne by the republisher, in exchange for some form of exclusivity, republishing can provide a quick and inexpensive route to international markets. In this sense, for software, content and intellectual property creating companies, republishing can help them scale and quickly ramp up. A disadvantage is that the company is tied into a republishing contract that's usually long-term and exclusive. By delegating the translation, localization and local support, this model can mean a loss of control over the localized product and customer experience. There are some other issues to consider when appointing republishers. One is ownership of the localized version of the product. A republisher that invested in localization may be justified in claiming some ownership rights in the resulting localized product. Another issue to consider is access to source code and confidentiality. For a software company, access to source code is usually highly controlled and is rarely released to a third party. However, translation and localization for some products may require modifications to source code, so this may be requested by the republisher. The financial arrangements often cause conflicts in the channel of distribution. The company often charges the local republisher the same transfer price or higher than is charged to a US distributor. The overseas republisher has to invest in product localization and marketing to create local demand, and to make the economics viable, the republisher sells the product in the local market at a premium over the US market price. Customers then see they can buy the product at lower cost by ordering it directly from the US, and this creates a second or grey market for the product. The official channel via the republisher can be bypassed by customers buying on this grey market. Of course, this is more of an issue for English-speaking markets, where overseas customers do not have a language barrier and the US grey market source product is acceptable to buyers. But such grey markets also develop in non-English speaking countries where the customers are not prepared to pay a premium for access to localized product. The retail channel is well known to all shoppers, and many companies reach the market by selling their products through retail networks. Examples from the high-tech sector would include the sales of PCs and electronics through retailers like Costco and Walmart. Large retail deals can lead to rapid growth in sales and provide the company with the ability to quickly reach mass markets. However, there are costs associated with merchandising, and the company can be required to provide the retailer with stock on consignment. The stocking and consignment costs can be substantial when dealing with large retailers. The products can then sit on the retailer's shelves for some time. Returns policies are an issue for product manufacturers when dealing with many retailers. The retailer sells the products and provides the customer with a customer-friendly returns policy. The customer keeps the product for some time before returning it to the store and receiving a full refund. The retailer in turn returns the product to the manufacturer and demands a refund from the company. This has been a real issue for electronics companies selling products to retailers with returns policies that allow the customer to return the product several years after it was sold. When the product's returned, it can be totally out of date and of little value to the company. However, the customer is still able to demand a full refund. So although the company may sell its products via retail chain for, say, only a matter of months, the returns can continue for several years and require investment in administration and returns tracking systems. High-tech companies often bring their products to market via OEM channels. The company sells its products or component to an original equipment manufacturer who rebadges the product or combines the component with its own brand products. An example would be the Logitech mouse, which was sold and rebadged by PC manufacturers such as Dell, Hewlett-Packard and Apple. Logitech sales of mice through the OEM channel can be measured in billions of units, so this channel can be very successful. Other than R&D costs, the cost of setting up an OEM distribution channel can be relatively low. The key is to win sales contracts to supply large OEM manufacturers. Of course, a major OEM agreement can lead to a rapid growth in sales, and business can scale up very quickly in these situations. However, the supplier is heavily dependent on the OEM manufacturer, and sales can quickly disappear if the manufacturer decides to switch to an alternative vendor. Competition is fierce for these supply contracts, and manufacturers have strong bargaining power, and this can often mean product margins are squeezed. The supplier does not also have a direct relationship with the customer and is unable to establish its own brand. One issue to consider for OEM suppliers is the liability they can incur for patent infringement. The OEM client usually insists on the supplier providing indemnification for patent infringement lawsuits. If the product or component supplied infringes a patent and the OEM manufacturing client is sued by the patent holder, the supplier is contractually obliged to bear the costs. Where a small independent manufacturer does not present a valuable target and may escape patent infringement suits, the large manufacturing client may be an appealing target to a patent holder, and these companies do attract patent infringement lawsuits. Picking up the tab for these suits can be an issue for the company to consider when entering OEM supply agreements. Startup companies are always looking for an exit route, where the investors can sell the company or IPO and gain a return on investment. As we mentioned in more detail in the slideshow on unintentional poison pills, the distribution arrangement entered into by the company can have a long-term implication and can lead to a situation where the shareholders are unable to exit as the company fails to present an appealing acquisition target. An existing company with an established route to market may be looking for new products and revenue streams. Signing a distribution agreement is sure to be a much less costly alternative to buying the company. With a renewable or perpetual distribution arrangement, however, the company could be leasing the product out to a potential buyer indefinitely, providing the buyer with no incentive to buy the company outright. And even if the product meets with success in the market, the investors could be forced to wait decades for a return on their investment. Now, this does not apply to all distribution agreements. A well-structured deal could actually act as the first step in the process of selling the company to the distribution partner. If the owner of the route to market demands a distribution deal and can't be persuaded to buy the company and its products directly, a distribution agreement that's structured as a try-before-you-buy deal with a firm termination date may force the partner to buy the company or lose the right to distribute the product in future.